Thank you guys for joining. Quick introduction. My name is Mark LaMonica. I look after the individual investor team here in Australia for Morningstar. And today we're going to talk about how much you should pay for a share. We're going to get a little bit into margin of safety, which we'll see, maybe is exciting. But first, anything you hear today is general advice. I don't know anything about you, so I can't offer personal advice. Also, if you're over in New Zealand, you can get our FAP off of our website, morningstar.com.au. And if you would like personal advice, the New Zealand regulatory authorities would encourage you to reach out to a financial advisor. All right, let's get started. So, a couple weeks ago, and we've obviously been doing these things for a while, a couple weeks ago, we talked about how to value a share. And we'll get into a little bit of a refresher while we go through today. But we also want to talk about, once you've valued a share, once you've estimated the value of a share, how should you determine how much you should pay for it? So that's what we're going to talk about today, which should be, I hope, an interesting topic. The other thing I forgot to mention, ask questions. Questions are always appreciated. It'll make it more exciting. And it's already been a very exciting day for me because I got my hair cut, which is nice. I had to wait an hour, but still, I got my hair cut. Okay, we're going to start with a couple quotes. We'll start with a quote from chapter 20 of The Intelligent Investor. So for those of you that have attended these before, there are two chapters of The Intelligent Investor, one of the most famous books ever, written by Benjamin Graham. Chapters 8 and chapters 20 are the two chapters that Warren Buffett says are the only chapters you need to know about to be a good investor. And chapter 20 talks a lot about the margin of safety. So we've got a quote here from him, and he's saying the secret of making sound investment. So the sound part of it is important. Sound investment is 3 words, margin of safety. So there's one quote. We've got another quote from the aforementioned Buffett. So very simply, you guys can obviously, hopefully, mostly read, but what this quote is looking at is sort of the concept of the margin of safety, which we're going to get into. If you're going to build a bridge, maybe you should make sure the bridge can hold more than the trucks driving across it, is my very simple summary of that. But that's what we're thinking about as investors. We are thinking about how do we protect ourselves from things that go wrong. And a little bit of a buffer is always helpful. So there are 2 reasons that we use the margin of safety. And what the margin of safety is just when we estimate the value of a share, we are taking a discount from that value before we'd actually purchase it. And there are 2 reasons that we want to do this, and we'll get into some more of that. So why do we use it? All right, first we have to acknowledge that no matter how much work we do, how much analysis we do, and we'll talk a little bit about how to value a share in a second, but how much analysis we do, how much homework we do, we spend all day thinking about one company and trying to value this company, we all have to acknowledge that the future is, of course, unknowable. We have no idea what's going to happen. We have no idea. And the now ridiculous example I always use, we have no idea that some global pandemic will start. We don't know what's going to happen in the future. So we should take a margin of safety. We should not buy things that are priced for perfection, because I think, as we all know, perfection will not happen. The second thing that we need to acknowledge is that precision in calculating and figuring out how much something is worth, number one, is unknowable because the future is unknowable, but also that level of precision is not needed to make good investment decisions. And this is really important because a lot of people feel like, especially I think when we walk through those examples of spreadsheets, how to calculate the value of a share, people believe that you need to have some level of precision. And I think the financial services industry also encourages this notion. The way that they talk about shares, the way they talk about what's going to happen in the market, seems like they can predict the future and that they have some secret that the rest of us don't. So we do need, yes, I will use an example. So we do need to acknowledge that there is no precision when we're calculating the value of a share, that this is an estimate. And it's because of what we're doing. We're estimating the future. We are trying to create something that, of course, is unknowable. So that precision does not matter. In order to be a good investor, that precision does not matter. But the reason it doesn't is because we're going to take a margin of safety. All right. So let's go back to, and this is, of course, is still in PowerPoint. Let's go back to our good friend, the discounted cash flow model. So this, of course, is a simplified version of a discounted cash flow model. I'm going to go through this quickly. Anyone who is interested in that how to value a share concept and actually march them through the spreadsheet, send me an email. It's mark.lamonica1@morningstar.com. I can shoot you over a recording of that webinar if you are interested. But let's revisit a couple of the concepts. I'm going to do this pretty high level. What are we doing when we're valuing a share? Well, there are two really, really important inputs that go into this. It is estimating the cash generated by the company in the future. So remember, any time that we go and we buy a share, all we care about is the future. And I use this Bill Miller quote all the time. But Bill Miller, a famous fund manager for Legg Mason, says, I'll paraphrase a little bit now, all the information we have, or all the value of a share occurs in the future. All the information we have is in the past. So when people are going through financial statements, when a company reports earnings and we all get excited and we're looking at it, remember all of that is irrelevant. That is the past. Now we use the past as inputs into what we think is going to happen in the future. But just remember, the past does not matter. It does not matter if some company you bought made $20 billion last year if they never make another cent again in the future. It is irrelevant. The share price will go to zero. You don't get any value out of something that happened in the past. So the two things we're looking at is cash generated in the future. That is what we're estimating out here. So these are the cash flows. Then we are discounting them back to the present day because we, of course, understand the principle of the time value of money, which is $1 today is worth more than $1 in the future. So we discount back those future cash flows. So I have overly simplified this model. So basically what I've done is we've got revenue up here. We're working out free cash flow, and I've made everything the same every year, except for I've given us 5% revenue growth. So pretty simply, what we're saying is this company is going to grow 5% revenue into the future. That is going to translate into 5% free cash flow. So very, very simple. All right. And there's a reason I wanted to create a very simple model. So this is what analysts do. Now, as I said, this is very simplified, both in the inputs I put into this model and also just this spreadsheet I put together. It's obviously illustrative and not sort of the 7-tab monster spreadsheets that our own analysts use here. But in essence, this is what they are doing. They are predicting cash flows out into the future. All right. Then they're discounting them back. So these are the two big inputs. All the work that I would do as an analyst to figure out what I expect these cash flows or what I estimate these cash flows to be in the future. And then, of course, the rate that I use, so in this case, the weighted average cost of capital, to discount things back. So those are the two things that matter. And this is where we always talk about valuing your shares, both an art and a science. So this is a spreadsheet. I know that all these formulas work, but what matters is the input, and the input that goes in there is, of course, the art part of things. Yeah, so John's asking if the recording I mentioned is already on YouTube. Yeah, you can visit Morningstar Australia YouTube. Go into playlists, look for Investing Bootcamp, which is what this is, and then you can spend the next, 60, 70 hours listening to me talk, which I cannot imagine anything worse than that. All right, so let's keep going, then I'll start getting into the questions that are coming in. So what I did is I took this model and I made a couple changes, very minor changes, and so what the change in the value is. So the value right here, and this is the same, I don't have to move, this is the same thing. We come up with a value of $12.07. So we'll walk through in that YouTube I was talking about. It walks through all of how you do that. But I made two changes to these big inputs that go in here. One is, of course, revenue growth, because I've created this sort of perfect situation where 1% revenue growth will equal 1% free cash flow growth. So 1% revenue growth. What happens to the value share? It goes up 8%. 1% reduction in the discount rate. So in other words, interest rates fell by 1%. Close to 18% change in the price. But the point is that these are relatively small changes, right? And so, yeah, it is very difficult for an analyst to go out there and estimate out free cash flow for 5 years, let alone 10 years that we have in here. So that's a very difficult job for anyone to do. But if we go back to that Warren Buffett quote, what is he saying? All we need to do is we have to have the knowledge to make a very general estimate about the underlying business, right? Like that we cannot, Warren Buffett can't, our analysts can't, you can't come up with an exact to the penny value of a company, or perhaps even within dollars, obviously, depending upon what the share price is. But the point here is that we just need to be good investors. We just need to make general estimates about what something is worth and then buy it at an appropriate price with a margin of safety. All right. What factors influence? Because the next question everybody takes is how everyone has is how big of a margin of safety should we use? Well, let's think about this logically. So, yes. So John, and anyone else who wants the spreadsheet, just send me an email. So mark.lamonica1@morningstar.com, and I'll send you the spreadsheet. All right. And I say that in the YouTube video as well. I'm just handing out my email address. Like, I don't know, I can't think of anything appropriate to say there, but probably get the gist of what I'm talking about. All right, what factors influence the size of the margin of safety? All right, so if we think about this a little intuitively, right? What are we looking at? We're looking at the business risk of a company. And companies have different levels of business risk. So the larger the risk, larger the business risk the company is under. Now that can be specific things about the company or how outside factors would influence the company. Larger the risk to the company, which means the larger or the more unpredictable those future cash flows are, the bigger a margin of safety we need to take, right? So just like Buffett's bridge, that if we don't know how much the truck is going to weigh driving across the bridge, it could be 10,000 pounds or it could be 15,000 pounds, the bigger the margin of safety we should build in when we're engineering that bridge. So same thing with companies, and companies are very different. And I think that this is probably an underappreciated concept for many investors, that there are companies that are a lot riskier than other companies. That doesn't mean that both of them can't be good investments, but it does mean that you should know that. And you should think about how your buying decisions and selling decisions would change based on the riskiness of that company. So let's look at a couple of factors that are going to influence how risky a company is. And this is why we all need to think like business people when we're looking at companies, right? Like we need to understand the business so that we can make statements like, I don't think this is a very risky company. All right, so let's look at a couple of different things here. So let's look at financial health. So just like with people, and just like anybody that you would lend money to, the better financial shape a company is in, the less risky it is. And this is a simplistic, but I think an illustrative example that when we went into COVID, there were two airlines in Australia. One had a lot of debt. One had a better balance sheet. Virgin, Qantas, who's still in business? Virgin, of course, went out of business. Why? Because they had way too much debt. And when something unexpected happened, like travel got shut down, they could not handle it. And they couldn't raise more money. They couldn't borrow more money. They couldn't get more money from shareholders because they had way too much debt. Qantas was able to do that. They were able to raise more money from shareholders, for example. They were able to go out and access more capital, so they stayed in business. So the financial health of a company is very, very important. So how can we determine financial health? We can look at credit rating. So that's an external rating agency that, of course, is doing the heavy lifting for you. So every company that goes out and borrows money, and companies borrows money from public markets, will have a credit rating. So we can go look at their credit rating, higher the better, obviously. We can go look at their balance sheet. We can look at their debt to equity ratio. And the credit rating, sorry, I should have added. The credit rating is just an assessment of how risky it is that they will not pay back their bondholders. So the riskier that is, of course, that they will not pay people back, the more precarious of a financial situation they're in. We can go look at their balance sheet ourselves. We can look at their debt to equity ratios, one of many ratios that people look at to assess the financial health of a company. So debt to equity is, looking at how much compared to the equity capital they have on their balance sheet, how much debt do they have? More debt is bad, right? So if we think about debt to equity, higher is bad. We can look at their interest coverage ratio. Do they make, that's just looking at interest payments they have to make on the debt they have. What buffer do they have in the earnings that they're generating versus that interest coverage ratio? You do not want that to be tight, because any drop in earnings means they can't pay back their debt, right? So just like if you were to go lend money to somebody, you wouldn't want the interest they're paying you back to be most of their salary. That would be a problem for you. The maturity schedule of their debt. So one of the things about debt is, of course, if you were issuing bonds as a company, you could have been issuing them for years and years and years, and they mature at different times. Why do we care about maturity schedule? Well, I think there's a couple property developers in China that are showing you why maturity schedule matters right now. So covering your interest is one thing, but the other thing, when bonds come due, you have to pay back the bondholder. So if you're not able to do that, that's a problem. You go out of business. All right, then we can look at how good they are from an operating standpoint. Now we can look at two different things. So we can look at operating leverage. So basically operating leverage is the degree to which operating income changes based on changes in revenue. So pretty simply, it means that if revenue grows 10%, how much are earnings going to grow? And this ties into margin as well. So how much are they going to make off of every dollar that they make in the future? How much are they going to make in profit? And what we want to look at here is how do companies scale basically up and down? So one of the reasons that investors love tech companies is because they scale almost infinitely, right? Like, and I know I always use this example, but this isn't like a 1950s industrial company where if you want to grow sales past a certain point, you need to build another factory, right? That's a huge outlay. Tech companies can kind of just scale and scale and scale. And it's sort of the nature of the business, right? They don't need a lot of employees. They don't need property, plant, and equipment generally to make any money. So they are very, very scalable. So that is business risk as well, because if you can scale really quickly up, it means as you're coming on the downside, if earnings start dropping and if revenue starts dropping, you're also generally in better shape. You're not going to be stuck with all of this giant outlays of property, plant, and equipment that you're not making any money off of. External forces, so understanding the business model. So this one is obviously on the art side of things, but understanding what are the influences to a company's business model. So a huge one here, obviously in Australia, is commodity prices. So obviously we've seen some interesting things happen with iron ore, but if you are a BHP, if you are a Rio, I think we can agree, if we look at BHP, we can agree that it is a great company in terms of its ability to cheaply mine iron ore, for example. But the problem with that business model is, and the problem that is inherent in all business models of price takers, is that they have really no control over the price of iron ore. In theory, they have some control. They could stop producing it as one of the largest producers in the world, but that's not a very good way to run your business. Not making something or not actually selling what you're mining. So miners, for example, they have a lot of external forces that influence their business, and there's a lot of risk baked into that. Whereas if you are a company that has more control over the prices that you can charge, you do not have some of these factors. But these external forces could be anything. It could be the countries that you operate in, if there is a lot of geopolitical risk in them. That's something that's outside of your control. There are all sorts of things that are outside of companies' controls. How can companies mitigate that? Well, think about some of the companies that have low business risk. They're generally consumer goods. They're generally selling vast sort of geographic areas. So if you're a Coca-Cola or Colgate-Palmolive or companies like that, you're selling in a lot of different countries. You're mitigating all that risk. You have lots of different product lines. External economic forces or anything else are probably not going to influence you that much, because somebody's always going to buy toothpaste or go buy a Coke, for example. Those are examples of companies with low business risk. And then quality, and all of this is baked into quality. So, of course, the moat rating, having a sustainable competitive advantage, denotes a company that would have lower business risk rather than a company that has no sustainable competitive advantage. And return on invested capital and return on equity are two measures of moat. They're two measures of the sustainability of competitive advantage. So all of these factors should influence how big of a margin safety you should take. So this may be an unpopular opinion, but if you are going to invest in a miner, for example, in my opinion, you should take a lot bigger margin of safety than if you're investing in a consumer goods company. Because there are so many other things that are outside of your control. There generally isn't going to be something, in my Colgate-Palmolive example, generally isn't going to be something that is going to widespread go out there and have the price of toothpaste all around the world or have the demand. That can very easily happen with commodity producers. So something to think about. That doesn't mean you shouldn't invest in them, but it does, it does mean that you should think about what price you're willing to pay. So we've got a good comment from Mike. So Mike's saying, what about the quality of the management team? Yeah, absolutely. Right. So what's that Buffett quote that you want a company that an idiot can run because someday an idiot will? Quality of management is very important. It's also difficult to measure. You can, of course, over long periods of time, if you've had a lot of stability in management, you can go back and look and say, okay, this is a company that's pretty strong. I think what I would argue, Mike, is that, Paul's saying the Morningstar Stewardship Rating, which I'll get to in 1 second. I think that there are other signs that you can use that denote good management, right? And so Stewardship Rating that Paul came up with is certainly our assessment, our analyst assessment of one very important part of management, which is the ability to allocate capital effectively. Is management doing a bunch of dumb stuff with your money? I mean, that's what we're looking at. So effective capital allocation means that you're not going out there and overpaying for companies that you acquire. It means that you're not out there buying 50 corporate jets. It means that you are not paying everybody lavishly when they don't deserve it. Those are some of the things that we look at from a stewardship rating. So thank you for that, Paul. Okay, so we've got a couple other questions. Wow, lots of questions, which are good. So I'll try to answer ones that are directly relevant to what we're talking about, and then I'll answer the other ones at the end. So we have a question from Matthew saying, so he's talking about what about first to market advantage? So I think you're talking there about sustainable competitive advantage. So let's talk a little bit about first to market. It is an advantage, but it can be eroded over time. And I think there's all sorts of different examples we can use. So having an idea, so if we think about sort of capitalism in general, right, and businesses, first thing you need is a great idea. And that's generally how every company starts, right? You come up with this great idea, and then it takes off. Good for you. The problem is that everybody just copies your idea, right? So There are situations, which we'll get into in a second, where that doesn't happen. But yeah, a lot of people are going to copy your idea. That is why we need to have a sustainable competitive advantage. So when we're talking about that, we're talking about protecting return on invested capital and return on equity, and the margin that a company generates. So, I'm trying to think of an example, but you start something, you capture a lot of market share, everyone's going to copy you. Good example. Okay, a good example is the buy now, pay later space, right? So the buy now, pay later space, everybody and their mother has a buy now, pay later product now. So every bank has them, PayPal's got one, credit cards are introducing them. There's so many different companies out there that, literally merchants, stores are filling up with the stupid stickers of the things that they take. Now, Afterpay certainly has an advantage because they were the first mover in a lot of this. But if we sort of look at what's happening is it's getting eroded. And one of the reasons that Square bought Afterpay is because what they're trying to do is they're trying to combine sort of two sets of stickiness. Payments, which are very important, obviously, for companies, is the ability to process payments. And then, of course, this sort of buy now, pay later consumer led, which is what a lot of these companies are trying to do, capture consumers that will then force retailers to accept their buy now, pay later. So they're trying to stick those two things together. Now, why are they doing this? They're doing that because there are companies, Visa and MasterCard mostly, that are incredibly entrenched in the payment space and basically have control over the payments globally. So they have sustainable competitive advantages. This buy now, pay later payments combination that Square's trying to do are trying to create something similar that's sticky and entrenched. But if you go look at a company like Zip, what's happening to Zip? Well, everyone's really disappointed with their earnings because they spent a ton of money on marketing. Why did they do that? Because they realize, I don't know if they realize, but in our opinion, our analysts' opinion, they don't have a sustainable competitive advantage. So what does that mean? It means over time, return on invested capital will move down towards the cost of capital. We've gotten a little off topic. Why? Because you have to keep spending money on marketing, or you have to discount, or you have to do all of these things that are bad for you as a shareholder, just to continue to try to stay in business or try to actually grow your business. So that's kind of what we see. So we just do need to be careful about first mover advantage. It is an advantage, but if you don't have something else, then over time it gets eroded. So that was a very long-winded answer. So I apologize. All right, we're going to move on, but we will get back to all the questions, I promise, because I don't have anything better to do. So, all right. So how do we apply this at Morningstar? This concept of riskier companies and applying different levels of margin of safety. Well, we do it through something that we call our uncertainty rating. So when our analysts are building out those models, when they are estimating what future cash flows a company will generate, discounting back to the present, when they're doing all of that, they also assign every company an uncertainty rating. Now, an uncertainty rating is essentially just looking at the riskiness of the business, the riskiness and the predictability of those future cash flows. So once again, it's very easy to predict a giant global company's, it's not easy to predict, it's easier to predict a giant global company's future cash flows versus a tiny startup company operating in a very niche market. So that's why if we take Colgate-Palmolive and toothpaste and personal care goods, no matter what happens with the economy, no matter what happens in one particular country, if they ban toothpaste, any of that happens isn't going to impact them that much. If there's a smaller company, there's one product line that doesn't have the financial strength, there's all sorts of impacts that can throw that company off. We talked about this last week. We were talking about the difference between small cap companies, which have higher business risk, and large cap companies, big companies that have lower business risk. So our analysts assign an uncertainty rating from low to extreme on every company that they cover. And we'll get into some specific examples that I thought were interesting, but I thought they were interesting. All right, so low Low business risk, extreme business risk. So what we do is we take a bigger margin of safety for companies that have more business risk. So hopefully intuitively this makes sense. There's more factors that are going to influence and make those future cash flows less predictable. Then we want to take a bigger margin of safety between what we think something's worth and what we'll actually be willing to pay for it. So we have 5 different ratings on shares from a valuation perspective. Now, our analysts do not assign star ratings to shares. They calculate their estimate of the fair value of the share, and then it automatically just gets compared to the share price. And that's where we show if it's undervalued or overvalued. So if we think something's worth $10 and it's trading for $1, then okay, that's very undervalued, right? That's all we're doing with the star ratings. But what determines which star rating you have, or the amount difference between our fair value and the price that's trading for, is the margin of safety through this uncertainty rating. So 5-star stock are the stocks that we believe are trading for the biggest discount to fair value. So if we are in low uncertainty, basically you need a 20% discount, so less than 80%. If the share price is trading for less than 80% of the fair value, we will give it a 5-star rating. However, if we get up to extreme on the other side of things, it would need to trade for a 75% discount or less than 25% of the fair value for us to assign it a 5-star stock. So what we're basically saying here is we would say for an extreme business risk, things that we think are, well, I think extreme speaks for itself, things that we think are very, very risky, we're telling you to take a 75% margin of safety. Whereas something that's a very low business risk, we're saying only take a 20% margin of safety. Now, I will say that there aren't that many companies that are low and extreme. So I think in low, there's something like 8 or 9 in Australia. So Coles, Woolies, Endeavor, like those are all low risk companies. And once again, if we think about their business models, Endeavor obviously used to be part of Woolies, sells booze, right? Dan Murphy's. If you're like me, you go every day. But Coles and Woolies, you still have to go buy groceries. If we're in lockdown, if the economy is doing terribly, if, I don't know, think of some scenario, you're still going to probably go to Coles and Woolies and buy groceries. So low business risk. So that's how we use margin of safety. All right, let's use a couple examples. All right, so I was thinking about what would be a good day. So I looked at 2 companies here. This is Anheuser-Busch. They, of course, are the global beer giant. They have ticker BUD. And then this is Canopy. That's a weed company in Canada. So I was thinking, you know, a beer and a joint, right? So that's a good day for, you know, some people. Of course, I would never touch either. But let's look at these 2 different examples. So we have BUD, which I actually happen to own, at a 5-star level, and we have Canopy at a 5-star level. All right, let's look at the differences between them. So BUD is trading at a 39% discount. So our analyst believes that the fair value of Budweiser, Anheuser-Busch, is 90% or $90, and assigns a medium uncertainty rating. And the reason I did this is I could not find a low share that trades at a 5-star level. So I had to go for medium, right? So little demonstration maybe of how the market actually does value lower uncertainty. So it's trading at a 39% discount. And you can see here, a 5-star price is anything below 63, which it is. 1-star price is anything over 121. So those are calculated off of what we were talking about before, right? Medium uncertainty, extreme, or what's the other one? The other one's very high, which is also how you get if you use their products. So yeah, in this case, we can see where those star ratings come in. If we look at weed, so these are Canadian friends with lots of greenhouses. So $38 is the fair value. It's trading at a 57% discount, and it's still kind of right in the same cusp between sort of 5 and 4, not too far away, both of them. So this is just an example of how when you look at anything on premium, you can see how this uncertainty level gets baked in. I'm just going to keep making jokes about Canopy. So yeah, it gets baked in to the price here. So what are some of the things that we can look at here? Economic moat, none for Canopy, right? Wide for Anheuser-Busch. Capital allocation, so how to management, it's the new stewardship rating. I guess I should have mentioned that, change the name. So management, how effectively do they allocate capital? Exemplary, which is a good thing, standard. So those are some examples of kind of how we take these measures into account. So thank you guys very much for joining. I appreciate it. Sorry about all the dad weed jokes. I think that's more probably indicative of my age than hopefully the quality of my jokes. But yeah, thanks for joining, and I'll be back same time on Thursday if anyone wants to join there. All right, thank you guys.
Any advice in this video is general advice prepared by Morningstar without reference to your financial objectives, situation, or needs. You should consider the advice in light of these matters and any relevant product disclosure statement before making any decision to invest.